All right. Hey, guys in the chat are talking about this CoreWeave. What the hell is this thing? By the
We've
way,
only been talking about it for 6 weeks.
No, but what is? I mean, I don't mean what is the company. What is going on? It went up 21% today.
I think it's got to be some, knowing nothing, it's got to be some sort of thing with a very short float, market structure type of thing. Squeeze.
Well, NVIDIA reports tomorrow. So CoreWeave is probably like a 2x NVIDIA if it's a good report, is my guess.
I don't know, dude. It's wild. I love it. I love it.
You love it. This thing is nuts.
It's nuts.
But it's in the news. There's like news on it, but I don't know what the news is.
I
right.
bought it on the IPO day at 38. I sold it at 40.
Look at you.
It's at 123.
Playing it like Buffett.
I mean, there's no way I was holding on to this. No way.
All right.
Wild.
So there's a Barron's piece. Barclays downgraded it to equal weight from overweight, but he raised his price target from 70 to 100.
What is this nonsense?
And I think the stock's 115.
Yeah, 120. Love it.
What is this nonsense is right? I don't know. All right. Shout out to all the pounders who are joining us live. What a day. What did the Dow do? 700 today? Gained back everything from last week in one day. Beautiful deal with Europe, it looks like. Everybody's excited. All right. The usual gangsters are here. Simon E is here. Buying some CoreWeave tomorrow. Look out below. LOL, I know the feeling. Matthew Stevick, go Knicks. That's right.
Fuck yeah.
Michael Griffiths, trying to shout out some new people that we don't get to. Chris Landry is in the building. He's giving a shout out to Serve. Got in at $6. I sold it today, Chris. I made a little bit of money, believe it or not.
You know what you did, Josh? You made chicken salad out of chicken shit.
I did. I bought it at 19, and then I bought it at 7. And
That's chutzpah. I don't have that.
That's cold. I don't care about the fundamentals.
Yeah.
Anyway, I'm gone. I'm out. All right. We have a sponsor tonight. Michael, tell everybody who the sponsor is.
Damn right we do. Today's show is brought to you by our sponsors at Betterment Advisor Solutions. Imagining a better future, that's the first step. Did I say future?
Investing in that future, yeah, with Betterment Advisor Solutions is the next. Whether you're launching your own practice, looking to streamline client onboarding, or just searching for efficient ways to scale your firm, Betterment Advisor Solutions is here to help.
Listen up. They automate to make tax optimization simpler. They provide support to make administrative tasks easier.
At Betterment Advisor Solutions, they're building innovative tech, all for anyone who's ever said, I think I can do better. Grow your RIA your way with Betterment Advisor Solutions.
Learn more at betterment.com/advisors. Investing involves risk. Performance not guaranteed. Let's get to the show, Joshua.
So we're back within a couple of percent of record highs. Last week was a tough week. S&P did negative 2.6%. I think the NASDAQ was about the same. But we gained it almost all back in one shot because the quote-unquote bad news from Friday, where Trump goes 50% tariffs on the EU, they're not negotiating, and I'm getting frustrated, and it's time to play my game the way I play it or whatever. The market sort of reacted to that, and then on Sunday of Memorial Day weekend, he's like, no, actually, just spoke with the EU, spoke to Ursula, we're good now, we're going to pause that until July, and we'll make a deal. So Europe gapped. I don't know if you saw the European opening. So the European stocks take this more seriously than American stocks do, I think, at this point. Yeah. But whatever, look, this is now a joke. We talked about it a couple of weeks ago. We did a show called "The Market is Laughing at the Tariffs." So I guess that's still the story, and we're laughing again. And the 50% tariff just became zero, or back to the baseline of 10%, and that was good enough today. And people are excited about NVIDIA. Call buying for NVIDIA going into the report is gangbusters. But let me just read this, okay? So this is the tug of war. On Friday, Trump said he's out of patience. On Monday, he said JK. And then the European Commission President, Ursula von der Leyen, said, I spoke to Trump. It's good. Don't worry. And that's all within 48 hours. And then we got a conference board data dump on consumer confidence you tell me if you understand this. The biggest jump in consumer confidence for the month of May in 4 years, mostly driven by an increase in future expectations. That's a component of the survey where they ask people how they feel about the economy over the next 6 months, what Callie refers to as the vibes. That shot up by 18 points, the biggest monthly gain since May of 2009. The present conditions climbed too. That's how Americans say they feel about the economy currently. That is now at the best level since November. What do you think? What's going on here?
About which part? The conference board or just everything?
Both.
So
just this, I'm framing it as a tug of war. Like, and for every negative, you get a positive, and it's like day to day. It's like it's almost too easy.
You're right. The market is laughing at the tariff noise because on Friday, after a V-shaped recovery, the bears had every chance to just take back a little bit, right? It would have been perfectly reasonable tariff announcement or not to just give back 4%, right? And on Friday, the VIX got as high as 25, which is nothing, closed at 22. Bond yields were unchanged. Stock futures opened. I get the market opened, I don't know if it was down 1% or more, closed at the highs of the day. They totally looked past this, and they were right. Now, to the conference board thing, what do I make of the numbers?
Well, they bought, right. They're not even waiting till the next day to buy the dip.
No.
They're like, oh, Trump spooked the futures with tariff bullshit. We're buying them right now.
I know we're going to talk about this later. I'll save it for later. Kevin Gordon tweeted, consumer confidence up month over month in every income bracket in May. And I think we don't need to get into the numbers here per se, but I think a lot of this is just nothing more than a rebound. I have no idea, where this thing goes from here. I don't really care, to be honest. But I think that these numbers were so depressed. Chart off, please. There was just a lot of pessimism, like a lot of pessimism in the face of hard data. And I think after a couple of weeks and months of digesting the nonsense, I think people are like, all right, I'm over it. It's fine.
Like, is there a such thing as a correction that ends because people get bored? Like, is that a thing? Is that a thing now? Like, think about this. Like, we're in this like TikTok era where it's like scroll to the next thing, quick. It's like I can't watch more than 9 seconds of something, and I'm just out. Like, what's next? Is that kind of what's happening here? Like, I can't focus on this tariff thing anymore. I've been hearing about it for 3 months. It doesn't matter.
Ben made a similar point this morning. Like, the market can only digest one threat at once just because of our attention span. Like, we can't focus on too many negatives.
Well, what's the other? There's no other threat. It's just this. We went into this tariff thing like full speed ahead in January. The market was ready for tax cuts, deregulation, acceleration in GDP, Fed cutting later in the year. There is no other threat. It's just this.
Outside of the normal talk, valuations, a softening economy, peak earnings, like outside of the usual stuff, there is nothing exogenous that is in our face that's going to take the market down.
Right. Like, except like the usual threat, like geopolitics, like the general. All right. Let me read this from Adam Parker. Right now, it feels like no one has strong conviction, bullish or bearish, about the stock market. He should go talk to a 27-year-old. Fundamentals might deteriorate from here. Just look at Ross Stores missing earnings and pulling guidance on Thursday. Deckers Outdoors down over 20% on Friday on a reduced outlook. And Walmart CFO warning that tariffs will cause them to push up prices by 8% on some products in 2 weeks. But at the same time, there's hesitation to turn too bearish. Why? Retail flows are still strong. Momentum remains positive. Real optimism about AI, companies proving real productivity gains. Input costs like energy and metals are down. And in aggregate, logistics costs should not be an impediment for most companies with prices at these levels in the second half. The dollar is also weaker. That helps U.S. earnings. The top 100 U.S. equities showed during the post-COVID era they were relatively immune to rising prices. At present, investors have generally now been conditioned to ignore President Trump. Blah, 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 blah,
Wait,
blah.
hold on. Can I just double click on one thing, as they say in podcast land? There's hesitation to turn too bearish. People were so freaking bearish a month ago before the V. So I think people are only now, not necessarily turning bullish, but I think Adam's right in the sense that people, how could you have conviction right here? I understand
I definitely don't.
I understand having conviction to the downside. Like earnings are going to probably continue to come in a little bit lower expectations. I don't understand having conviction to the upside.
So he said, no investor we talked to on Friday thinks the U.S. will have a meaningful and sustained 50% tariff on European Union goods. We tend to think, and many investors agree, the only tariff-related conversation that really matters is what the U.S. does with China. And then he concludes by saying, taking it all in, even if macro headwinds persist, there's a growing view that S&P 500 earnings might end up being less impacted anyway.
So that's the thing.
That's the big thing.
That's the thing. If you are of the mind that the AI hype cycle is still being underappreciated and you don't understand NVIDIA's going to blow your faces away, then okay, fine. Maybe that's why you're super bullish. But other than that, I don't see it.
Here's some stuff I did over the weekend. I was talking about taking the bear trap theme further and talking about how you get out of a situation where you could potentially be forming a short-term top. These charts are not updated to incorporate today's price. Let's put up the first one. This is just the three indices made a lower high relative to the original high in February, all three of them at the same time. And I think the point was like, we can get out of this. All you need is, I had a great conversation with Tim Apple. I had a great conversation with Europe, and you're off to the races. I didn't predict that from Monday morning, but I literally said this could happen Monday morning at 5 a.m. I forgot that it was a long weekend and the opening day was Tuesday this week, but that's like actually what happened. It happened on Monday. The market wasn't open, but we got a barrage of tweets about how everything with Europe is fine. Put up the next chart. So we were sitting on this 200-day moving average as support going into Friday after the quote-unquote fake bad news. And, again, the big idea here is just like, look, there's a couple of get-out-of-jail-free cards here. One of them is that earnings continue to come in better than expected. Another one is all this tariff shit is fake and nobody believes it anymore. And then the third is unlimited buying by the investor, the retail investor, the individual investor. And I honestly think that that's trumping pretty much everything at this point.
This was a premature post by you. I'm surprised you wrote this. First of all, the gap didn't get filled, number one. But,
well, no, we were on the way to a gap fill. I didn't say it happened.
Well, it does say it right there in the chart. I think you and I and everybody else would have been absolutely face melted if we just rocketed straight to new highs. Right?
Well, that's what it's doing right now.
No, it's not. No, we did have a little chart back on. We did have a little bit of a pullback. Dude, this is your fucking chart.
I know. It's a 3%.
You literally
pullback.
rollover. So we had a little baby rollover.
I know, but it's 3%.
Yeah,
we made it back in one day,
which made perfect sense.
What's the S&P up today percentage wise? Is it a 2% day?
1.9%.
Yeah, I mean,
wild,
crazy. All right. So here's why. More important than any of this shit. This is part of the big get out of jail free card. The relentless bid into ETFs is relentlessly bidding. Here's a Wall Street Journal. Investors have plowed a record $437 billion into U.S. ETFs so far this year, unfazed by the wildest market since COVID. And if inflows maintain the current price, historically they accelerate in the summer and fall months. It will mark the second straight record year for U.S. ETF flows. Chart on. Look at this shit.
That's wild.
What is that? $260 billion into equity ETFs year to date. Another $140 billion into fixed income. Next chart. Vanguard S&P 500. This is VOO, which is taking in, it looks like, more in dollars than any other ETF on the planet. $65 billion year to date. So we've had 4 months.
Yeah, it's wild. It really is.
Let me read this. No one fund benefited, chart off, more from the surge than the ETF industry's new champ. Vanguard Group's S&P 500 ETF. The ultra cheap index fund has soaked up $65 billion in net inflows this year, on the way to becoming the world's biggest ETF by assets. It took in, Batnick, $116 billion last year. So it's going to break that at the current pace. And the guy from Vanguard, Greg Davis, the CIO, said during that period of tumult in early April, we saw a 5-to-1 buy to sell ratio. Investors have a tremendous amount of cash sitting on the sidelines.
Man, I'd love to know. I would love to know what it looks like historically. Like 5-to-1 sounds crazy, but for Vanguard investors, is that crazy? I don't know.
Well, if he's shouting out April specifically, it must be out of the norm. I'm not sure. I don't know.
Can't scare these people. I love it.
Larry Fink was in the Middle East last week saying there's $11 trillion still in money market funds. So, like, I don't know, does 10% of that go into what's the iShares one? VW.
I don't
IVV.
have a chart of this, but if you look at money market funds as a percentage of total assets, you would be talking about it much differently. Like it's fairly normal. It's not super duper elevated.
Right. Well, right, because the total assets are elevated too.
Yes.
It's
Exactly.
not elevated relative to other assets. Yeah. I asked Sean for this. So VOO is Vanguard's version of SPY for people that aren't aware of what we're talking about. I asked him for net flows versus total return because I really don't think the buyers give a shit, and I think I'm right. So do you see what I'm doing here? The bars are the net flows into Vanguard, and the total return is the red line. That's just like how the ETF is performing. They just don't care. They like it's trending up. There are a few weird months here and there. There's probably some seasonality, but this is monthly flows into VOO over the last 3 years versus rolling monthly returns, and it's just coming.
Yeah.
I don't know. You see anything in that chart worth pointing out, or it's pretty self-explanatory, right?
It's relentless. Doesn't stop.
It's the relentless bid. All right, you're up. You're
okay.
Up to that.
Bespoke tweeted, "Buy the dip is back. The S&P has gained an average of 0.31% on the day after down days this year, the strongest showing since 2020. And wouldn't you know, we had that today. So the average is now higher because the market was down on Friday and we were up 1.87% today. And this is the picture of the market today from Finviz. And it's bright green, not a whole lot of red.
What is even down? I don't even know what's down. What could that thing in
VeriSign?
Oh, Palantir had a negative day today, but
not
less
flat.
than 1%.
No, the red is VeriSign. You had O'Reilly. I think did AutoZone report? AutoZone was down 3.5%. Not a lot of red out there.
Very interesting thing about VeriSign. It's the utility of tech. It's just it's like web registration, and it acts more like a utility than a tech stock. So it actually makes sense that would be down on a big green day. You see this chart? It's been on the best stocks list since September, October. I haven't managed to say a word about it. I have great taste. I never owned it, but that's like it's like a utility for the internet.
All these names got mini baby wrecked. Although it was a wreckage after DeepSeek.
Yeah. How'd that go?
Yeah. One of these days, my friend, buyers will be punished. But
we're gonna talk about the tariff rhetoric losing juice. The New York Times has a piece out today called the Taco Trade. Taco stands for Trump always chickens out. So I mean, this is not me. This is nobody get mad at me. This is the New York Times, which also you probably hate if you hate that statement that I just made. But this is what Jason Carrion, who writes for the Times, had to say. Stock markets jumped on Tuesday with the S&P posting its biggest gain in weeks. The index rose 2%. Analysts attributed to President Trump delaying a proposed 50% tariff on Europe. They also talked about tacos, or rather the taco trade, which is short for Trump always chickens out. The tongue-in-cheek term coined by a Financial Times columnist. Who did that? Who was the FT columnist? Do you know anything about it?
Who is? I don't
I'll
know.
tell you right now. Oh, Robert Armstrong. Oh, I like that guy.
Oh, he's good.
We've had him on
He's-
the channel, actually.
He's the John Authors of the FT.
Yeah, he's good. So he coined this term. Mr. Trump makes tariff threats only to rebound just as sharply when he relents and gives countries more time to negotiate deals. The market dropped on Friday. Wild threats by Trump are not unusual. Given the damage the U.S. would do to itself with this tariff, he will probably not follow through. And, of course, he did not. Taco is the new YOLO, I guess. Is that a good way to phrase it?
No, I don't
What do you think?
It's,
You're not going to use it?
No.
I don't use that term chicken out
Yeah, right. Who says
either.
that?
That's like an 80s term, I feel like. Like people used to make like the chicken noise to each other. Yeah.
Credit to me. I never did that.
Never did that shit.
Yeah, I would have been way too embarrassed.
All right. Did you read my comments at Politico Money Morning Newsletter today?
I read him in the doc.
What'd you think? I give good quote. I give great quote. I really do.
Dude.
What? I do. I spoke to Sam
keep it
Sutton
PJ.
over the weekend. So he was trying to write a piece about the markets, how the markets are pricing in the trade war, and I totally spun him. I was like, dude, let me help you. Nobody cares about the trade war in the stock market. It might be a little bit in the long bond, like the tax stuff, the tariff stuff. The stock market is not spending even 30 seconds on this anymore.
Not anymore.
And I laid out like the earnings are outperforming, and people are way more focused on that than they are about tariffs that may or may not happen this summer. And he changed, to his credit, he realized he's missing the story. He changed what he wanted to write about.
Before you quote yourself,
Yeah.
can I give you something?
Please.
This is wild. So we've spoken about this a lot. I've never seen it quantified. So I'm so glad that Savita did it. Mike Ziccardi tagged this. So Savita says the U.S. has a higher proportion of low-income consumers than almost every other OECD nation, which I didn't know that. Kind of wild. But here's the
Wait, the
upshot.
highest what?
Proportion of low-income consumers.
I would have guessed that.
Okay, I would not have. But here's what matters. But its contribution to total consumption is low, and its contribution to S&P 500 earnings has declined to an estimated 2%. Holy shit. So it's fucked up to say, but just through the lens of the stock market and earnings, the low-income consumer does not have an impact.
Doesn't exist.
It's wild.
It's not in the stock market. Like the companies that derive their earnings from serving that portion of the population,
So when people talk about like
they're not important.
delinquencies and inflation hurting the low-income consumer, like obviously from a human element, but that's not what we're talking about. It doesn't matter to the stock market.
I think it does eventually when the dots get connected, and it turns out like all these wealthy people own these mortgage bonds and things that require the lower income people to keep making their payments. I think that's where that connection becomes meaningful. But we are so far away, at least I think, we are so far away from a situation where an S&P 500 financial is like talking about impairment as a result of low-income people not keeping up with their bills.
Dude, Ally, which is the most exposed, like this chart looks fine.
I brought this to the show last week. We talked
Capital
about
One looks great.
We talked about who do we have on the show? We had Rich Bernstein on Thursday, and we talked to him about like that mortgage delinquency chart. It's like, okay, you could see it now, the uptick, but it's not exactly telling you that the household balance sheet is in shreds. That's not what's happening. It's just like a lot of these things are coming off of generational lows and normalizing.
Right. All right.
They're not
quote-
signaling financial crisis.
Give me a quote.
I don't know. What was it? Oh,
You're about to quote yourself. You love quoting yourself.
well,
You give the-
this
you give
was
the
the
best
point I
quote.
was trying to make. So I'm going to quote Sam, and then my quote's in here. I said, the marginal buyer or seller of stocks is a 32-year-old, and they literally don't give a fuck. They are reacting to market sell-offs by adding more money to their ETFs and their investment accounts. Blah, blah, blah. The booming population of retail, and this is Sam, retail investing platforms like Robinhood, now home to 27 million investment accounts. Chicken Little forecasts about downturns have never materialized, gave rise to a class of investors who haven't adhered to conventional logic during market moving events. To which I said, Moody's downgraded the Treasury. Fuck it, I'm buying Palantir. These are all real F-bombs I'm giving him. I'm serving F-bombs all day long to the journalists that I talk to. I think the bottom line is we do have a confluence of things like strong ETF flows, better than expected earnings.
Buybacks.
Buybacks. We have a more resilient class of mega cap companies that are not as susceptible to every squiggle in the economy. We have subscription-based businesses versus transactional businesses. We have
services,
all these things.
Services over goods.
And then like the biggest thing, the most important thing is we have this demographic tailwind of people who understand long-term investing, understand compounding, and literally don't even read the news and don't care. And they're just, Moody's, I don't even know what that is. Here's another $4,000 for my VOO.
And should I buy 1 time, 2 times levered, or 3?
Yeah, maybe I'll double it. Oh, there's bad news in the stock market. Maybe I'll double it.
Should I buy calls that expire next week or next afternoon?
Hang on. Nicole is saying that they should have taken the over on my F-bombs. I actually think that these are asterisk F-bombs because I was just quoting something else. I'm not like actually saying them. I said them at another time, and I'm just repeating what had already been said. Those are not F-bombs that are endemic to the content that we're doing tonight. Do you follow me on this?
Mm-hmm. Sure.
What do you think? Asterisk or because there's like bets, there's money involved.
Stop.
So I'm being dead serious.
Okay.
I'm being dead serious. I think I was minus 16.
This is not a betting platform.
Okay. Do you agree that the demography of the stock market is underappreciated or starting to become more appreciated but still underappreciated by the market watchers?
I don't know. It's hard to say. I don't know how to gauge their appreciation over or under.
Do you think enough attention has been paid by the people who watch the market
to the
fact that we have so many buyers
the
who don't
demographic
care?
tailwind from younger investors. We were talking about this today. Robinhood net deposits was like a big number. Was it 57 billion over the last 12 months, 18 billion in the last quarter? It was like real. But that's like a drop in the bucket. That's not propping up the market.
But remember, we're not talking about the bulk of the money in the market. We're talking about at the margin. The daily buying and selling is a fraction of the money that never moves.
But if they're insta buying, they're not the marginal anymore. They're just there. They're like insensitive, so they're not the marginal buyer or seller. They're just there.
I sort of feel like they get really bullish when the market falls, and the guy from Vanguard just told you they were 5-to-1 buyers versus sellers in April.
That's not the kids.
You don't think so? That's not kids with 401ks?
No, I don't think they're buying VOO. I think they're probably buying SPY or IVV.
Okay.
Could be wrong. All right, I wanna are we good? You have anything else? Any more quotes of yourself?
I do. I have more, but we'll do them another time.
So last week with Rich, he was talking about like how there's too much liquidity and the next bear market is going to be a doozy for not really market reasons per se, but I just wanted to reframe that conversation a little bit.
That was a good show.
It was great because it's like, even interest rates can't slow us down. What could get this market to just chill? And I want to push back against that. And let me lay out the case and then I'll hear your thoughts. Let's throw this first chart up, John, please. So the 30-year Treasury rate and the S&P 500, I don't want to suggest that they're moving together at all, but it's just unusual to see them both at the upper end of their range. That is not what you would expect. You would expect Treasury bonds, particularly at the 10-year and longer, to act as some sort of governor for risk appetite. And it ain't happening at all. Next chart, please. So it's like, interest rates don't matter. Oh, really? All right, look at this chart that chart kid cooked up. So I had him look at inside the S&P 500 since the first hiking cycle in March 2022. And if you look at the left-hand side, the bottom 3 deciles in terms of market cap are getting rocked. Only 15% of companies in the lowest market cap decile, only 15% or higher, and we're talking about 3 years removed later. 3 years later, same thing with the second decile and the third decile. They're up a little bit, but it's only a 50% win rate. So certainly companies that are more exposed, that have higher cost of capital, are paying the penalty for higher interest rates. The next chart from Torsten Slok shows growth in total employment for the Mag 7. Apple, Microsoft. Yeah, this is Mag 7. Okay. What a coincidence. The Fed started hiking interest rates and boom. You're telling me that people inside of the technology sector, employees, aren't feeling higher interest rates? They sure are. Look at U.S.
The workers.
The workers.
I agree.
Look at U.S. existing home sales. Look what happened when the Fed started to hike. Are you kidding me? Absolute ice age. Ice age. And then finally, we have venture capital, particularly the mega rounds, the growth equity, demolished since the Fed started hiking. So it's very simple in my mind. Chart off, please. I think what happened was it was AI. In 2022, ChatGPT hit the scene and the market bottomed a month later and we never looked back. Had that not happened, we would be singing a much different tune about the impact of higher interest rates on the economy and the stock market and the Fed's ability to maneuver the economy and the market. And we are looking at the market today and saying, I guess interest rates don't matter. They do matter.
I think that you and I actually said that in real time. How many?
You definitely did. You were the first to say it.
We did a video, AI saved the stock market.
It literally
did.
Yeah.
Oh, I totally agree with your take. But I do want to, there's only one thing I disagree with, which is in your first chart. This is the 30-year Treasury versus the S&P. I don't think what we're saying is that the absolute level of rates doesn't affect the stock market. I think we have a chronology disagreement because look at the end of 21 when it became apparent to everyone interest rates are going to have to go up. That's when we start getting these emergency level inflation reports.
And
right?
but Josh, you're right. Look at 22. The stock market got killed.
That's exactly right.
So it's adjusted.
So it's not about the level, it's the surprise. And the big surprise for people who were riding the market up in 2021 was that there was going to be a vicious hiking cycle the next year. Nobody knew it. Some people thought it might be necessary. When it became obvious that it would be necessary, you had a legitimate, although not very long-lived, bear market in the stock, in the S&P. And I do agree with you. The only reason we have enjoyed most of the gains over the last 2 years is that we got a tech cycle.
All of it.
We got a tech cycle.
And we keep acting like 2022 didn't happen. And we keep acting like the first quarter of 2025 didn't happen. Oh, these kids are going to be punished one day. Dumbass. In 2022, Amazon, in 2022, it's like not a million years ago, Amazon had a 56% drawdown. 56. I just picked up Amazon and Google. Google fell 44%, okay, in 2022. Yeah. And just the first quarter, Amazon and Google each fell 30% after getting cut in half. Like, investors have been punished. It hasn't been one way up, oh, easy money. For who?
The thing is, it's been a really long time, and we had 2 back-to-back years of 20% gains. And this year, we had a correction that went on for about 4 weeks.
This happened in the first quarter. Amazon fell 30% in the first quarter. Yeah. So, and how much did NVIDIA fall? We're acting like it didn't happen just because it recovered?
I'm talking about annual, but I'm talking about like calendar returns.
Yeah, 23 and 24 were great years.
Not just great, they erased all of the pain of 22 and then some.
I'm just tired
you didn't have to wait long.
Of old people yelling at young people that'll have their comeuppance. They have been having it. This hasn't been a straight up line. It just hasn't.
Yeah. The young people also, they're taking their lumps in places that you're not aware of. If they are employee shareholders of venture-backed companies, which increasingly young people are, that hurts. A lot of them probably thought they would have had an exit by now. A lot of them were on Zillow picking out the house they were about to buy with their stock option. Companies cannot go public at the same rate that they were. Valuations are getting smashed down. Last week there was an IPO we talked about it for a second. What did I tell you it was called?
I don't remember. I never heard of it.
Okay, MNTN. This is actually an interesting business, and I'm going to start following it. So MNTN is a company that enables small businesses to buy television commercial airtime via a really easy technology platform. Like you submit your 30-second video to the platform. The AI makes suggestions of like what networks and what shows that ad might work well in based on the demographic. And it's like a way that you don't have to like call NBC and say, hello, I'd like to run a commercial. MNTN will help you run TV ads.
What's the point?
The point is the last private round they did was at $2 billion and change. Mm-hmm. And they came public at $1 billion valuation.
Yeah. Well, Circle, which we're going to discuss later.
So now everybody was clapping on the floor, and I was applauding. I think it's great. But my point is, it's not like young people in the markets haven't taken their lumps or paid the price or lived through anything. They have, and they are. Can you imagine somebody who put 10% of their portfolio in NFTs? You think that person hasn't undergone a correction?
Right.
So I agree with you. I think the old people want to see like a 2-year bear market because that's their experience. We don't do anything for 2 years anymore. I just watched the final.
We had a 2-year bear market. 2022 was 2 years. It legitimately was. It literally was.
All right. I don't know. Didn't feel that way.
The market bottomed in October of 2023. It was 2 years. But go ahead.
Didn't feel that way. I don't know. I just watched the last season of Last of Us. It lasted 7 episodes.
No spoilers. Yeah, that was weird.
No spoilers, but here's a spoiler. It was 7 episodes.
Yeah, it was weird. Why'd they do that?
Is it a miniseries now? But this is my point. We don't do anything that takes 2 years anymore.
Mission Impossible was like 2. It was so long.
You saw it in the theater?
Yeah, I saw it last night.
I think I'm out. We'll talk about that another time. I think I'm out of that. All right, let's move on. David Solomon is like back. He's so hot right now.
He was in the doghouse.
Oh, they thought he was done. So to recap, before we get to the numbers here, David Solomon is the CEO of Goldman Sachs. He won a power struggle. It was either going to be him or Harvey Schwartz. Solomon got the job. Harvey ended up at Carlyle, where Harvey's a friend of the show. He's good. David Solomon got the gig from Lloyd Blankfein when Blankfein retired. And David Solomon was doing fine. They were double and tripling down on some of the consumer stuff they were trying to do. They were trying to turn Goldman into more of a household brand. They did a credit card with Apple. They launched Marcus, which was like an online bank / robo-advisor. And they were sort of flirting with Main Street stuff, and it all went terribly wrong. And the stock paid the price for it. I think Goldman got cut in half. And what happened was all these Goldman Sachs partners who have a lot of sway internally were not liking the bonuses that they were getting, and they were calling the press. Like they were
$7 million. How dare you?
Like they were doing these 3 martini lunches with Charlie Gasparino at Pietro's and talking shit. And so every day the New York Post had another story trashing David Solomon, Goldman's in shambles. Why are we in the consumer business? What happened to the profit sharing pool? Why is this guy in the Hamptons DJing a COVID party when the stock price is, So it was really ugly. And then here's the news that we just got. I guess this is like the inside baseball from the Wall Street Journal. I wanted to share this with you. So David Solomon went to the board of directors and told them he was going to start outing the naysayers who were talking. Rule number 1 at Goldman is you don't talk to the press. He was going to start outing the people who were responsible for all this negativity and getting rid of them.
Why didn't he just fire them?
He did. Here, let me read this. Solomon was going through a brutal stretch in 22 and 23. The consumer lending expansion was generating billions in losses, hurting Goldman stock. Money-making partners were leaving. Solomon had taken flack for his attention-grabbing side gig DJing. Solomon told Goldman's board he was going to take action, pushing out troublemakers who he said were undermining him with their leaks The board told Solomon he had their support. By last year, longtime executives who had openly criticized his strategy were gone. The departure sent a message inside Goldman. No one is safe if they go up against the CEO. And Solomon, who is now 63 years old, has cemented control for the foreseeable future. This year, he got a 26% raise and an $80 million bonus to stay for the next 5 years. So look how quickly things turned with the stock price and the fundamentals. Let's do some charts. This is the 5-year price performance of Goldman Sachs. Rocking and rolling. Recently made a new high at the end of 24 and is still hanging in there. Stock has annualized at 30% a year for the past 5 years. No company fires its CEO if the stock price is annualizing at 30% a year, right?
Right.
Okay.
That's wild.
Earnings hit $14.12 for Q1, which is up from $11.58 a year earlier. Net revenue $15 billion, 6% year over year, 9% over last quarter. Return on equity 16.9%.
Nice.
Yeah, asset management and wealth management on fire. Net revenues $3.68 billion. Authorized up to $40 billion in common stock. So like they're back. The stock is back. DSOL's back, and I think the instructive part of this. Tell me what your takeaway is. For me, it's like it's so easy to look at a stock price and come up with a narrative where it's just going to keep going up or down.
100%.
We have to remind ourselves like nothing lasts forever. No trend, no narrative. Like even Tesla, like the narrative on Tesla is no one will ever buy a car from this jerk again because everyone's mad at him. Dude, he's back. He's returned to office.
Yeah, what a
the
turnaround.
stock price is ripping because they know the narrative has changed now. He's back. He's innovating at Tesla again. He's not running around the White House with Trump. Like you can't ever get so positive or so negative in response to, I don't know. What do you think?
I think that they did a lot of damage to their brand equity. Like that was real. That was a horrendous misstep. And
Goldman.
I'm pretty sure we spoke about it in real time. Like, what are they doing? Like, Goldman is like the creme de la creme. They're going down market. Like that's not Goldman. And they fixed it. They cleaned it up. They got rid of it. And I guess all's well that ends well.
When you're a new CEO, and Solomon is 63, so let's say at the time he's taking the company over, he's late 50s.
But he was an insider, though.
Yeah, but he's a Gen X. He's a young Gen X. Like he wants to do something different. They want to make their mark on the
old Gen X.
Old is he old? Yeah.
He's 63.
What was Blankfein though? Was Blankfein a boomer?
He's a young boomer, I guess.
Boomer. Okay, fine. So it's Gen X, the first Gen X CEO at Goldman.
No, but he wanted to make his mark. I get it.
Wanted to make his mark. Like they all kind of want to put their stamp on this is what we're doing with Goldman. I totally understand that.
Yeah.
It was wrong. It just didn't work.
All right, let's talk about Circle's potential IPO. Not potential, I'm sorry. Circle's IPO. They're going public on around June 4th, I believe. There was talks that maybe they were sniffing around Coinbase or Ripple for an acquisition. So before we get to Circle proper, I just want to talk about the state of the IPO market. This is from Jeff Rich. Chart on, please. Jeff Richards, excuse me. All right, he says the last 20 IPOs were up 55%. Six
Really
are
good.
over 100%. So back? I mean, these are real numbers. Like these are.
Would you have guessed that? I wouldn't have.
I don't know. I knew that it was healthier. But no, that's real shit. So the story with Circle
Let's give some of these names before we go to Circle though, because this is really interesting. MNTN, which we talked about 5 seconds ago.
Which one is Hinge? Was that the boner pills or is that something else? Oh, that's the virtual
virtual
therapy?
physical
Right.
therapy.
Right.
eToro is more crypto shit. CoreWeave is like Nvidia's.
Hang on. eToro is not crypto shit. It's like Robinhood.
Right. So Robinhood is crypto shit. Yeah. Where
Oh,
does profits come from?
Dude, you wouldn't describe Robinhood as crypto shit. It's a brokerage platform.
Sort of just did.
No, it's a brokerage platform.
Service Titan, which I also think is a really interesting business. I was there the day that came public. That's like software for landscapers and pool companies, service companies. It's like Toast. You know how I'm invested in Toast?
Yeah.
It's like the software company for restaurants. Service Titan is sort of the same thing, but for like people that have services business. Really interesting story. Founded by two brothers. I think they were immigrants, or their dad was an immigrant to this country. It's worth reading. Ingram Micro is a private equity catch and release.
Klaviyo,
Mobileye was spun back out from Intel.
Klaviyo was a big one. Instacart, Arm. So the average of the last 20, it's a 900. It's basically $1 billion IPO size at an $8.5 billion valuation.
That's
So,
great.
healthy.
55% returns
Healthy.
is phenomenal.
All right,
Honestly,
so the mission statement from Circle is to increase global economic prosperity through the frictionless exchange of value. And their whole business is this thing called USDC, which is the second biggest stablecoin behind Tether. There's about $60 billion in AUM, I guess they call it. And there's no yield as far as I can tell. And so their business model is clipping the coupons of short-term treasuries.
why would somebody put money into a stable coin with no yield? Explain like what the purpose of this in the ecosystem is.
So once you are in crypto, once you are on the rails, you are on the rails. And there's no like, outside of this, there's no like crypto to dollars. You'd have to go from Coinbase back to JP Morgan or wherever you want to go. So if you are in crypto, you are a crypto native or you're a crypto whatever, and you've got, I don't know, whatever, $30,000 in Bitcoin, and you want to sell 5 because, you know, you want to take profits, well, then you're going to go into a stable coin.
If you're in like real crypto,
Yeah,
not crypto ETFs.
Because that's where you go. There is no cash. You go from Bitcoin to a stable coin, and then you want to get back in, whatever. And so also like the ability to just transact seamlessly, frictionlessly, instantly, without any fees, like it makes sense. It makes sense that this is the future of the financial rails.
USDC, which is the Circle stablecoin that we're talking about, is smaller than Tether. But
By a
my
lot.
understanding is because they are the house solution at Coinbase, it's growing way faster than assets going into Tether
There's also been a ton of allegations that Tether is up to some shady shit, that it's the preferred.
since day one.
Yeah, forever.
Okay. Here's the offering. New York Stock Exchange, which I found interesting, not NASDAQ. 24 million shares priced between 24 and 26. I'm sure that's going higher. They want to raise 624 million. JP Morgan is the lead. Citi and Goldman as well. Ticker CRCL. It's a $6 billion market cap, 6 and change, if they get that valuation, that many shares, which I think is also pretty impressive. I don't think this happens if Bitcoin's not 111,000, Trump's not president, and Coinbase is not one of the biggest companies in finance right now. Like you needed all those dominoes to fall for people to be excited to invest in a stablecoin company, right?
Yeah.
Okay. And that's how they make money, is they're holding cash that people have no expectations on.
It's one
and
for
they're
one.
earning a yield on it.
It's 1-for-1 backed by dollars. So let's look up these two charts. So this is the market cap. It's just the amount of dollars in the system. Got drained during the crypto pullback.
Apocalypse.
But look at this revenue. It's pretty wild. So in 2022, it was $735 million. And two years later,
Hold on.
it's
$735 million in revenue, just clipping bond interest off
great
of
business.
cash deposits. What a business.
and then 2 years later, boom, 1.6 billion.
Can I ask you a stupid question? Are Schwab and Fidelity asleep? Why would neither of them have bought this company out? They're like afraid of the regulatory.
I would assume, yeah.
Is that what it is? Because that's the business they're in. They're in the same business.
Fidelity is a very conservative business. I mean,
Schwab is in this business.
Well,
We'll hold your cash.
Up to now,
and
there
we'll
was
earn
just
on it.
there was no chance with the Gensler, the way that he was behaving.
They could have done this in January. They probably should have, honestly. Now this is another off ramp away from TradFi with tons of money in it.
I would say
they could have controlled it.
So I would guess the biggest risk to a company like this is interest rates. If the Fed cuts twice, that's directly less money.
They actually list that as their second biggest risk. So in every company that goes public has to file what's called an S1. And the S1 is a document by lawyers, for lawyers. Basically, it's just don't sue us. We have no control over the price. And here are the biggest risks that you're taking if you buy the stock, right? And they exaggerate. They'll put in 700 different risks just because when the lawsuits start after the first quarter where the company misses expectations, they're like, we told you this was the risk. Number one, regulatory uncertainty. I would argue that risk is pretty much gone.
Yeah.
But I get why they would put that at number one. Potential legal challenges, blah, blah, blah. Okay. Interest rate sensitivity, too. Circle's revenue is heavily reliant on interest income from reserves backing USDC. Fluctuations in rates can significantly impact profitability, make the company vulnerable to macroeconomic changes. Okay, that's a risk factor for every publicly traded financial institution, crypto or otherwise. Number three, market volatility. Crypto is known for its volatility. I would argue that is the basis of the popularity of crypto. Number four, dependence on key partners. All right, this one's big for me. This is what kept me from being interested in CoreWeave, by the way. I don't love investing in businesses that are built on other people's businesses. And I know that's a little bit naive because to some extent, everybody relies on everybody. This one seems acute. Circle's business model relies on partnerships with entities like Coinbase. I don't know what percentage of the money coming into USDC is coming from Coinbase. I guarantee you it's a lot and it's growing faster than other sources. Because what else is there? Who else is funneling money into USDC right now? Who are their other key customers? I don't know.
Probably Kraken. I don't want to.
Kraken?
Maybe. I have no idea.
Is that important?
I have no idea.
All right. What if, in other words, what if Coinbase introduces its own stable coin? I'm sure they already have one and I just don't know about it. And what if people just decide, Coke and Pepsi, I don't care, direct my money into this? Or what if somebody says, okay, new feature, here's a stable coin, and we're actually going to pay 5 basis points.
I think that's why they're coming to market at 4 times earnings.
Because people understand that risk?
I would assume, and others. I don't know what the next product is.
Well, here's fifth risk, competitive landscape. The digital asset space is highly competitive. Numerous players offering similar services.
I mean, it's a token backed by $1. Like I think that we spoke about this. One of the things that you shouldn't say is there's no moat. Right, like if you invested in companies that you had said that about 5 years ago,
yeah.
maybe it's anecdotal, but like competitive landscape.
That's one of the things. That's one of the things people, including myself, have consistently gotten wrong.
Yeah,
they said Netflix had no moat.
Right?
Yeah, and I've said that shit too, and
yeah,
I was dead wrong. By the way, I was dead wrong on Coinbase. My argument was, if we're really going to get ETFs, then why the hell would anybody transact in coins?
Yeah,
wrong. Concentrated voting here. So public investors, if they buy the stock of Circle, they're buying the A class, which is 1 vote per share. That's what's being sold. The 3 founders control the B shares, which are not currently being sold to the public. They have 30% of the vote because those B shares are 5 votes per share.
I like that. Like, as
the founders retain, they don't have total control. They can be outvoted by the A class. It's just very unlikely. If they have a 30% voting interest, like it's hard to picture the rest of the shareholders voting.
And you know what?
Them.
If you don't like it, you can sell a stock. That's not like a giant risk to me.
Net income of $156 million on revenue of $1.68 billion in 2024. That's versus net income of $268 million on $1.45 billion in revenue the previous year. So net income is falling, I guess, because yields on the
there's levers that they can pull in the expenses like that. That's
all right. Here's my bottom line. I actually think stable coins are the most useful, maybe only useful thing to come out of all this crypto stuff over 16 years of this now. They actually
that's a little bit dismissive. It's a new asset class. That's not nothing.
No, I think that this is the most useful part of everything that's been launched. This is the actual thing that works, and is needed. If you come out of Bitcoin with a huge gain, you need to go into something else, or else it's going into the traditional finance sector. And a lot of the people that are in Bitcoin are there for a reason. They don't want. So this thing actually does its job, and it's actually useful. I don't know about a company based around it, but I guess we're all going to find out together. I think I don't know. Can you tell me why if somebody has the choice, if they're on Kraken or Coinbase or anywhere, why would they direct money into Circle versus Tether or another product?
I don't want to make things up. There might be a yield component. I don't know. Yeah, that's the answer. I don't know.
All right. You buying the IPO if it opens roughly high 20s where they're pricing it?
I am not. There are too many other things for me to invest in right now.
Too many fish in the sea. All right. Guys, let us know if you're buying. We want to see in the chat, and let's get a little bit of the gauge of whether or not people are bullish on this thing. All right. I'm going to make the case. Sean and I wrote up Snowflake for best stocks in the market at CNBC Pro.
One of the poster childs of the excess in 2021.
So funny. We were talking about that 2021, 2022 comeuppance. This was it. A quick recap. Snowflake came public in September 2020, about a year before the top.
Was it $100 billion?
It was. They raised $3.36 billion, $120 per share. The stock opened at $300 per share. So I think it was worth $100-something billion out of the gate.
Nuts.
$75 billion right out of the gate. That was a multiple of 75 times its projected full-year revenue. Yeah, revenue. It was the first time I can remember seeing Berkshire Hathaway on the holders list of a hot new issue.
Everyone was like, what?
Berkshire's sold it way lower than 300. They're out of it. But if you thought that was the top, this is what's interesting. If you thought 300 was the top on IPO day, it went to 400.
Right.
A year later, the stock Snowflake topped in September of 21 or November of 21 at 402. And that was it. Then the stock collapsed 70% to a low of 107. When do you think it made that low? You looking at it now?
Probably around like June of 2022.
Last September.
Oh, my bad. Okay.
So it was, in other words, it came public September of 2020, bottomed September of 24. It had a 3-year period where if you held it, you actually lost money. A funny thing happened though. The CEO stepped back. The main CEO was a super popular guy in Silicon Valley, very well respected. But when you have a stock price collapse from 400 to 100, nobody cares.
Yeah.
He promoted the company's head of AI to become the new CEO. I forget the guy. I don't know the guy's name. And they started to put together a few quarters in a row of 25% growth and surprising the street. Like the estimates got pessimistic enough that they started to beat them, which is why Sean and I chose to write this name up. It hit the best stocks in the market list last week, made a new year high. It's still 50% below its all-time high, but it's a double off the lows. And the argument we're making is like professionals don't care if it's 100% off its lows. So long as the fundamentals are improving at a faster rate than the expectations, the stock has room. So do we have a chart of this? I don't know if we did a chart. Doesn't matter. Here it is. I think this is like pretty obvious. That 175 level is sort of meaningful. So if you're playing this as a trader, I don't know, that's where I would pivot off of. And if you're a little bit more of a long-term investor, wait for that 200 day to start rising a little bit, and maybe use that on a weekly closing basis. What do you think about this as an entry?
Here's what I would do if I was looking to get long enough.
Wait 3 days.
I would see how if it gets into the gap. See how it behaves at the gap. If it doesn't get into the gap over the next 3 or 4 days, it's going way higher.
That's what we said. Low volume pullback to see how it handles the bottom of that rally.
Yeah, no, but this looks good.
Fundamentals.
Yeah.
You're gonna be hearing more about this name as an AI story than you have previously, because again, the guy running the company started out on the AI side of the business, and now here were two things Sean pulled that I thought were important. The first is they have over 600 companies paying them more than $1 million each. That reminded me of CrowdStrike, which I now have, I think, a double or more in the stock.
All-time
Definitely
high
more.
today, right?
Yeah. Gross margins are expanding, so they're not at full year profitability yet. That's why this is not in the S&P, but that's where they're driving toward, and they'll get there. And when they do, this will be an S&P component because market cap wise, it's too big. But the other one, and I love this stat, Snowflake's net revenue retention rate hit 124% this quarter. Net revenue retention means the existing customers,
Spending
not
more.
only are they staying, they're upping how much they're spending with Snowflake. And I think that's because of the AI stuff. So you need your data clean, organized, unified. You can't do anything AI if your data is not in good shape. And that's kind of what Snowflake's business is. So if they can get closer and closer to profitability, I think the stock can stay, in this area. So that's our make the case. What do you
I
think?
like it. I do like it.
Bullish?
Bullish.
How many shares can I put you down for? Not yet.
Not yet. No, good to make the case. I like it. Okay. Mystery chart. I sent this to you, John, over the weekend. Okay, here we go. I forgot what it looked like. All right, Josh. So, would you buy this stock, or would you buy this chart? Excuse me. Does this look bullish?
No.
Okay.
I hate charts like this.
It's just sloppy range bound, right?
But what? This is a ratio chart?
Yeah.
Okay. Is it two stocks, two ETFs? What is it?
It's a company versus the index, and
Versus its own sector?
versus the S&P.
Okay.
And so what you could see is that over the last 5 years, you would have been no better off owning this versus the index.
No better off, or you'd be down.
Well, yeah, whatever. Same diff. Flat
Okay.
to down.
Okay. I'm going to say Apple.
Love it. Great call.
Look at that.
Really good guess.
Yeah, this thing is
This is a really big story. I think that is not being discussed. This company is not growing anymore.
No. They hit it's a replacement cycle business. They hit it. Everyone said it would happen.
It
And
did.
it happened.
And
it did.
And we were speaking about this a lot last year as it made that run, right? It was like the anti-DeepSeek. Like they were not in the business and they were getting the premium and they were getting the benefit for that. But the multiple never didn't make sense. Like why was Apple trading at 35 times next year's or however high it got up to?
I'm going to tell you,
And it's still
way
too
worse,
expensive.
way worse than their failure to be at the forefront of AI so far. They're getting their ass handed to them in court over this antitrust stuff. They lost to Fortnite, and this is crazy. This is actually crazy. I don't even think people know that this is going on. Epic Games sued Apple because Apple would not allow Epic Games to sell things in game and bypass the App Store. And Apple basically said, these are our terms and conditions. If you want to have an app in our App Store, we take a 30% cut of whatever your sales are if it's an in-app purchase. This applies to every app you can think of, okay? You want a Spotify subscription using the Apple App Store, Spotify is going to take a chunk of that money and give it to Apple, even though they compete because of Apple Music. Like, this is just the rules. And Epic said, we don't think that's fair. And they took them to court, and it's been going on for years. And Epic Games, which is the parent company of Fortnite, won. And a judge said Apple has to allow Fortnite players to be able to buy things from Epic Games in-game that goes around the payment mechanism of the App Store. And Apple refused to allow Fortnite to have an app in its App Store. And that is against the judge's order. So after the court case, Epic Games resubmitted its Fortnite app to Apple. Apple took 5 days and said, fuck you, no Fortnite. Now, most of the gamers don't care because they're on Xbox, they're on PlayStation, and that's how they access it. but people do like it's a big deal. And the judge wrote this like fire and brimstone missive back to Apple. Like, what gives you the right to defy a court order? You have to reinstate the game and give it permission to. So Apple losing that for the first time ever jeopardizes this cash machine they have. Like they had a stronghold on every app that wants to reach Apple users, and now they might not.
So no shit. The App Store is their crown jewel. It is the highest margin component. Everything else that they do is hardware, and every business line, from AirPods to the watch to the iMac to the iPad to the phone, they're all massive, amazing businesses. But guess what? They're not growing. And not to mention the threat from OpenAI and IVE, whatever the hell they're building. If they build the next generation of whatever user products we're going to do, that's not in the stock price. And so Apple's the best company in the world, but it's not growing, and it might still make money, shareholder yield and all that. They're going to buy back a ton of stock. They're going to pay the dividend. But is Apple going to outperform the S&P over the next 5 years, over the next 10 years? I'd be not surprised.
You know what's so crazy? It's still a 30 multiple. Like, you can't even come out and say, there's so much pessimism around Apple, I'm going to buy it.
There's none.
There's not.
And it hasn't outperformed over the last 5 years. What's to think it will over the next?
Yeah. And then they have the China stuff, and they want to pivot some of the. They only make one product. They only make one hardware product that matters in America. They make the Mac Pro, not the MacBook Pro, not the laptop. The desktop highest end computer is made in Houston. And Trump is like, hey, don't shift the iPhone from China to India, because that's not what we talked about. Make the iPhone here. And people are looking at each other like, no way. Cannot make an iPhone here.
Yeah.
Maybe you could make more of the computers here. I don't know. I would be the last person that would know. But so they are sitting. So Apple is sitting at this confluence of the absolute worst things. Worries about consumer demand staying up, worries about tariffs, worries about China versus U.S.
How about not being in AI and being threatened by it potentially?
Failing to implement consumer AI in a meaningful way. No AI on the phones in China. All the Chinese-made phones have AI, and Apple is trying to compete in China without it. Like, and then losing in court something that could literally jeopardize their profit margins from the greatest services business in the history of the world. That's where Apple is right now, and it's not great.
That's not great.
It's not great politically, geopolitically. It's expensive. So,
but other than that,
bye.
Yeah, the setup was nice.
All right, guys, that's it from us this week. We appreciate everybody who came out for the live. You guys are hilarious. Looking at your comments, you literally, we have the best audience on YouTube. Thank you so much. To those of you listening in podcast land on Spotify and Apple Podcasts, we appreciate you. We love you too. Please make sure to listen to an all-new edition of Animal Spirits tomorrow morning.
That's right,
Michael
Josh.
and Ben. Yeah.
Yeah.
And then we'll have the usual slate of content here on YouTube across the compound and the Ritholtz Cinematic Universe. We'll do Ask the Compound. We'll do the Compound and Friends. And you guys are going to love it. Okay, that's it. Thank you so much. We'll talk to you soon.
Good night.